Crowdfunding versus syndication. Which is a better investment option for dentists or doctors? That's what we're going to be talking about in today's video. You've heard of CrowdStreet, Fundrise, Realty Mogul, Yield Street. If you've ever delved into the world of passive investing, you've probably come across these platforms. But not only that, we're also going to break down the huge deal where investors lost $63 million of their invested cash in an offering that was offered on CrowdStreet. We're going to talk about what went wrong there and what you can do differently. All right, guys, welcome back to the channel. I'm Dr. Jonny Walker. Thank you. AKA Dr. Jonny Withananchi. I am all right, that's enough, guys. That's enough, guys. I'm a veteran endodontist as well as a self-made multimillionaire in real estate investing. On this channel, we teach doctors and high-performing business owners how they can achieve financial freedom through passive investment in real estate. Investing heavily in real estate has allowed me to take a giant step back from my clinical practice to working an ideal 20 hours a week, spending enormous amounts of time with my children, traveling 6 to 8 vacations per year, as well as having the time to pursue things that I'm passionate about, which is investing in real estate and educating my fellow doctors. Before we get into today's topic, I want to invite you, if you haven't already joined, to our Facebook group. It's called Financial Freedom for Dentists. It's a great way to talk with me directly, as well as 1,000 other dentists that are all on the same path to achieving freedom. All right, so let's get into today's video. A real estate deal gone bad hits popular crowdfunder. Like we mentioned at the onset of this episode, CrowdStreet is one of the largest platforms that allows small investors to band together to buy large commercial real estate. Now, in this project, CrowdStreet promised to give small investors access to major real estate projects, but missed red flags and funneled cash into firms that fabricated, aka lied about their past. Now it's facing deals gone bust where $63 million of investor cash has gone missing. After this story was published on Monday, CrowdStreet announced that it's replacing its CEO. The deal that went bust, the big one, involved a real estate developer called Nightingale Properties. In a bankruptcy filing this month, it was alleged that the buildings that they were supposed to buy were never purchased, and all but $127,000 of the $63 million of investor money was left. The rest was transferred to other accounts, including some belonging to Nightingale's Chief Executive Officer. CrowdStreet promised Nightingale offerings despite several potential red flags. The developer omitted results from 2 bad deals from track records shown to investors. First, when they show their track record, this company, Nightingale Properties, you go on their website, there's no mention of the deals, the bad deals. Right? Instead, they wait and give an average of all the good deals. And then, even despite being requested several times by several investors to also include that on the website, that there are bad deals, they still did not do it. As doctors, dentists, we are a very scientific people. We need to see evidence-based results in order for us to believe in a theory. And this is from the Wall Street Journal. This is a review of 104 complete deals and other deals that were aborted or still in the process, found that many failed to meet returns suggested in sales pitches, right? There's also accounts of when developers fell short of funds, they asked investors to pony up even more cash or risk losing the cash that they've already invested. So what's going on? These are the largest platforms, supposedly are showing the best operators in the business and portraying them as such, even if they lie. And is it a wonder that we're seeing such high amounts? I mean, relatively, to lose all of your money in a multifamily real estate deal doesn't happen that often. But here, we're over 10% of the deals have folded. It's better if you let a good operator, if things are not going the right way, is going to over-communicate with you. What a good operator is going to be fully transparent. They're going to over-communicate when there's bad things happening. They're going to tell you what's the problem, what's the effects of the problem, and what's being done to fix the problem. Other big red flags of CrowdStreet. CrowdStreet marketing materials provided rosy assumptions for real estate returns, right? In a pitch for private return investment trust run by company, it said higher interest rates, get this, have historically increased property values. The opposite is true. When interest rates go up, typically property values go down. How likely is it that you're gonna get these returns? And that's gonna depend on how good that operator is. If that operator is not so good, then those returns, you might as well take those returns. The pro forma, this is what I do with pro forma from a not so good operator. Those promises mean nothing, right? This is what I do with that pro forma. Now we're talking about real estate syndication. Let's talk about some of the similarities between the two. They both have deal sponsors. They're both passive investing. Whether you're crowdfunding or syndication, you're still deferring to the expert operator. They're the ones that acquire the property, get the financing, find the property in the first place, maintain a broker relationship, manage the tenants, manage the asset itself. All that legwork goes to the general partner. And that's what makes it a very truly passive investment for a syndication, somebody investing in a syndication or in a crowdfunding. They both have passive return potential. The work is being done by somebody else, which means any money that you get returns from that investment are truly passive. They both use online platforms, right? With syndications, you can see a deal, invest, create an account in a portal, and send wire funds all online. The main differences between a syndication and crowdfunding is syndication offers a more stable ownership structure. The primary difference between crowdfunding versus syndication is that the partnership between the sponsor and the investors in crowdfunding is less clear. Does the sponsor have any stake in their own investment? Is there a legally binding contract to hold sponsors responsible to investors, right? These are questions that you have with crowdfunding. It's a little less clear on who's the owner. But with a syndication, on the other hand, all investors in the given project will join the sponsorship as a member of a newly formed entity. We have an LLC or a trust that's going to buy a property, and the syndication investor is part of the limited partner that buys the property. They're part of the company that buys it, which gives them fractional ownership of the real estate. So you actually own real estate in syndication. Syndications are more likely to offer equity. In real estate investments, there's either one of two things. It's either debt, where you lend money and get a certain percentage of return back, or equity. With crowdfunding, it's more likely to be an equity relationship, right? Where you don't get to participate in the upside or the downside, and it's a fixed amount of returns. Crowdfunding is more likely to have lower investment. It can have as low as $5,000 on CrowdStreet or yield. Whereas with the syndications, they have a much higher threshold for investment. A lot of our investment opportunities are $100,000 minimum. There's some that are 50, some that are 25,000. So which one is actually better? One isn't inherently better or worse than the other. It really depends on what your needs are, what's your strategy, and what's your risk tolerance as to which one would work best for you. In my opinion, syndication is still the more superior investment if you have the capital and the ability to do due diligence. I'll break it down a little bit why I prefer syndication. So when it comes to investing passively in real estate, the most important part of the deal, like I would give it 50% weight, is the sponsor or the operator, the guy that's gonna be actually doing the work, doing the sweat equity. Now that general partnership, if they are a very good team, they can make a bad deal still work. And a bad operator or sponsor can take a great deal and make it go down the toilet. So being able to do good due diligence, ask the right questions of that key principal team is one of the most important things, as if you want to have long-term, good, predictable results on your investments. Now, the problem with doing due diligence on a platform like CrowdStreet is it's a faceless company. And a lot of times, like this Nightingale Properties, they're huge, huge funds, right? And you can never really talk to anybody, any of the key managing principals. There's too large of a company. And when you're a $50,000 or $100,000 or a $200,000 investor, you're just another face and just another person. So you don't have much weight. You may not get the given level of respect that you should get. On the other side of things, with a syndication, for us as a firm, I mean, when we invest, it's not just me investing, $50K or $100K. We bring millions of dollars to the table because we have investors' capital. So when we do due diligence on these operators, we do very strict due diligence, right? Because we have a lot on the line. We have a reputation on the line. We have millions of dollars on the line. So we go to a very far extent. We have checklists when it comes down to really getting to know operator. I get to know operator. Every guy that I've done a deal with, I've never just met this person. It's a person that I've been following on social media for at least 1 to 3 years. I've gone and visited their properties. I've sat in on webinars that they've thrown and shown on previous deals. I've went and done case studies on deals that they've done before. That's one of the things. And I believe that when you're with these crowd-funded sites, you just can't get that level of due diligence. The other thing is you want to find companies that are somewhere in the middle, right? You don't want a too inexperienced of a team, beginner team, right? But you also don't want to invest with the really, really big shots, right? They're the types that, hey, we got hundreds of millions of dollars assets under management. If one or two deals kind of go bad, hey, we'll just let it go because the other properties are going to bring the rest of the portfolio up. Whereas a small and scrappy real estate company that has syndication, where they have their mom, their cousin, their brother, and their grandmother all invest in the deal, these guys are gonna fight tooth and nail to make that deal work. They're not gonna just let something fall or something fall away so that they can sweep it under the rug, which is what a large company does. So you don't wanna be with too small of an inexperience, maybe not too large. I find that going somewhere right in the middle, where they're still hungry, they're still growing, they're at conferences, learning, they're providing, they're giving lectures, providing value. Those type of companies tend to be the ones that will give you a more sympathetic ear, right, when you're bringing capital. And you're more likely to be able to negotiate more favorable terms, as well as get to know these people on a human level. To me, that's the most important thing in investment, is doing due diligence. So being able to ask questions about the asset itself, ask questions, more pointed questions about the debt, more pointed and specific questions about the business plan, and if unforeseen things happen, what is the story behind this building? Every story has a building doesn't show up in the numbers. It shows up in the nuances. So all of these little things, getting a gut feel for the entirety of this offering, from the sponsor to the deal to the debt to the market itself, etc. And obviously this is an expensive game, right? We're investing a lot of capital when you go into these type of investments. And that's why I felt compelled to build this channel, to build this Facebook group, to build this platform. Because although there is a lot to think about, this is well worth the ROI for the time you invest into learning about propelling your finances. Is something that will serve you and your future family very, very well. If you've watched this episode all the way through to this point, I applaud you, because I'm sure that you've gained some type of value from this. I hope you did anyway. So if you did, like the video, leave a comment in the description below. Maybe give me some ideas of what I should make my next video about. And please do share this with other like-minded people. All right, guys, that's it for this video. I'm Dr. Jonny Walker. It's been a blast. And to quote the late and great Jerry Springer, take care of yourself and each other. Until next time, live a life of freedom, abundance. Peace, guys.